Do you think that technical analysis is a big factor when it comes to investing, or is the macro factor the main driving force?
Good question. Now, the way I look at it, and I'm looking at it from a wealth management lens, right, Pranav? So, I'm thinking about, say, for instance, a client comes in, sits down with me and say, Andre, this is my portfolio, where should I invest it in, right? And that's probably where the technical analysis comes through, right? In terms of, whether you should have a macro lens, whether you should have a top down, up, how do we, what kind of analysis should you make? Or how we do it anyway, it's more to do with managing the volatility, right? Because depending on the views of your market, right, you will always have this tendency to invest in what you know, right? So by that I mean, if you are looking at the first thing that you want to do when you invest overseas is looking at the blue chip companies, right? So, for instance, you've heard of the Magnificent Seven, right? Not doing too well this year, but the Apples, the Nvidia, and et cetera, right? That's something that you should have in a US based type of portfolio, right? Or if you're in Asia, then you're looking at a lot of the Chinese stocks like Alibaba, whatever. Tencent and all these different stocks, right? So what I'm trying to say is, from a technical perspective, we try to keep it quite simple, in which we're looking at probably large cap from an index perspective. Small caps is a bit more volatile because you'd really need to know those spaces to make sure you're investing in the right places. But with all these things, right, Pranav, you think about once you are dealing on the buy side, if you like, on the people that are buying products for your clients, then you don't really need to deal with a lot of those technical issues. What you do need to know is keep abreast of what the financial markets are doing, so you can explain it to your clients, right? But in terms of the actual in-depth tech analysis, you normally, in my role anyway, we leave it to the investment team to do so.
You mentioned asset diversification through indexes and looking at blue chip stocks. But what about other assets such as cryptocurrencies that have seen major recent adoption by individuals and institutions alike? Is that a viable option in wealth management and such?
Okay, good question, Tico. Now, crypto is a funny one, right? Crypto is recent, if you like, in terms of the adoption of it. The thing with crypto is, and I'll make a disclaimer, I have never advised anyone to go into crypto or Bitcoin. A, I don't understand it. B, if I don't understand it, how am I supposed to explain it to my client? And C, I see it as the very, very pointy end of volatility, right? Which means that, yes, you can probably make 30% in a day, but you can also lose 100% the next day. It's very, very volatile. So you have to know, again, it comes down to that goals-based investing, right? Because if the goal is to, create long-term wealth, right? And when I say long-term, it's, 5 to 10 years wealth, crypto could probably double or triple the returns of an index fund within a month, but it can also go backwards, right? So, whether that solution will meet your client's goal of investing or creating wealth in that long-term horizon, I don't know, right? The other thing that I don't know enough about crypto is that, with shares, right? You are actually buying a company, as you know, right? You're buying Apple, you're buying Nvidia, you're buying, Jarum, whatever it is in Indonesia, right? You're actually buying a part of the company. That logic doesn't stand in the crypto world. You're actually not buying any assets. You're actually just buying, Bitcoin or crypto or a system, right? Which has a unit price, which is then sold in the open market. It is gaining a little bit more legitimacy now, especially with the Trump administration, which I won't comment on. And there are actually now ETFs, that exchange traded funds concept. There are ETFs on Bitcoin as well now. So it is gaining a little bit more legitimacy, but at the moment I wouldn't. I personally don't invest in it.
You mentioned that your clients, they tend to invest for the long term, right? Have you ever dealt with clients that are not really looking for that as a goal, but more short-term cash to flip?
Yeah, absolutely, absolutely, absolutely. I mean, long-term goals is only one goal, right? And goals can be, it depends on what they would like to achieve. For instance, there are people that are looking at, a 13-month, an 18-month outcome. So they give you an amount and say, Andre, I want to invest this in 18 months. Give me the best return, right? Which is fine. We can do that. A few things come into play. Currency. So what are they investing in? USD, Hong Kong dollars, rupiahs, Australian dollars, and also the short-term interest rates will always be guided by the Federal Reserve, right? What the prevailing interest rate is, as well as you can actually. So for instance, the Federal Reserve rate at the moment is around the 3-4% mark currently. You can probably get double that for the same amount of time, but with increased risk though. So yes, there's definitely instruments that gives you more of a short-term outcome, but you have to understand that there's going to be some type of volatility coming through. For instance, I'll give you an example, right? So in Australia, so Oriana has a product called a private credit fund. What that does is it uses client investor funds to lend to different commercial property developers in Australia, right? The lend term is around 18 months. At the end of the 18 months, the developers will give the money back to the clients. But within the 18 months, you'll get an 8% return. 8% is pretty high, right? That's 8% US, 9% Australian dollars. So it's even higher, 9%. However, there's a risk, right? That within the 18 months, if those commercial developments doesn't come through, I mean, it's not only in Indonesia that you have property developers that's a bit dodgy, right? It's all over the world. So there is a risk as well of getting that return. Are you willing to take the risk? If then that's the question that you ask. And then if you are a logical person, you go, well, you've probably heard of the risk-free rate, right? So a risk-free rate is a rate that you're getting without any risk. Kayak term deposit, right? Like 2-3%, that's a risk-free rate, right? So anything above that risk-free rate, the risk increases as well, right? So 8 to 9% is nearly triple the risk-free rate, if you like, right? 3% at the moment, which means that potentially you're taking 3 times the risk. This is where it's important for you guys to understand your clients and know where they're at in terms of the volatility scale, right? For instance, if I gave this advice to my mom, for instance, there's no way she'd take it, right? But if I gave this advice to someone your age, for instance, right, who's very keen and actually is really looking at able to take that volatility, well, the outcome will be different. So again, hopefully what comes out of this talk, guys, is that understanding the client's goals and their characteristics is extremely important in ultimately putting them in the right investments.
You mentioned about risk. Is there like some kind of standard of measurement for the different types of risk? Let's say like a client's risk tolerance is conservative or aggressive. Is there some kind of standard of measurement there, or is it just up to judgment?
So we do a risk profile survey, if you like. So there's around, and I can send you the link. It's quite well used. So it's around 30 questions, which gives, which leads to a result of, having an understanding of what your risk standard is. The risk standard is, are you either defensive, conservative, moderate, or aggressive, right? Depending on the outcome of that survey, right? When you're asking about, what does that mean, right? So to give you an idea, for someone that's an aggressive risk profile, they're able to put up to 80% of their funds in an aggressive portfolio. On the other hand, if you're more of a defensive or conservative investor, it goes down to 40% of your portfolio that you want to put into more of the risky type of portfolio, risky type of investments, right? And balance, as the name suggests, probably around 50-60% of your funds will be in more of the equity side of things. Does that make sense? So that's kind of a standard of measurement. So for instance, Tico, if you did that survey and then you came out as an aggressive risk profile, right? I will then suggest you, we'll build you a portfolio with managed funds that has 70% in international equities, 30% in fixed interest and cash as a simple, baseline, right? Within that international equities, then you look at making sure you've got exposure to US, a little bit to Asia, a bit more now, and also Europe, and probably extremely small in emerging markets, I should say. So as you can see, right, the driver of this is knowing exactly what your risk profile is to be able to design the right portfolio for you.
In your opinion, what are some of what you call risky investments and conservative investments? So for your clients that are demanding risky investments, can you dive again into like what would you make them invest in?
Sure. So that's a good question. Now, risk is a very general term, right? The other part is the assumptions that we use, right? I'm assuming that you're investing in markets that are very stable financially, such as the US, Europe, China, Japan, etc. Right? So that in itself is already part of the consideration, right? To making sure that you're investing in countries where you're still going to get your money back, so to speak, right? The other part is in terms of what is a risky investor. It's because risk goes two ways, right? There's negative risk, there's positive risk, right? It's really the risk of your client losing their capital in a short amount of time. I think that's the ultimate risk, right? So you're really looking at their capital holdings and what that portfolio does to that capital holdings. If it stays neutral throughout the year, that's okay, right? But if it actually goes backwards because of the element of risk, right? Not only investment risk, there are different type of risks, right? There are administrative risks, there are financial infrastructure risks. Remember in Indonesia there was this scam happening in which people were investing in that share-based automated share system or whatever it is. I forgot what it's called. Some auto share portfolios that people were getting sucked into. That also comes to a lack of education, right? So, they're really looking more at the returns rather than what's driving those returns. But back to your question, what constitutes a risky investment is an investment that places risks or exposes the capital to unnecessary risk. I like the word unnecessary risk because that means that it's risk that should have been avoided if you knew enough about the client.